Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's first start with the results. Dr. Reddy has just come out with the numbers. SHRIKANT, AKOLKAR, senior equity analyst, research analyst at Ashika Stockbroking, joins me on the show. SHRIKANT, good afternoon. What's your sense of the numbers? What's your first take after seeing the numbers?
I think ex the lowering provision, I think numbers are in line with our expectation. In fact, if you look at the margin, it has beat our expectations. So we think the numbers have to be seen ex lowering. So the numbers are mostly in line with our expectation.
Give us more clarity on what this impairment is and what it means for the company.
So the impairment, the thing is, Dr. Reddy's have a CRL on lowering, and one of their competitors, Amneal, they have launched the drug. So Dr. Reddy was expecting this, but have not happened. So that's why they have taken the impairment, and hence the total impairment of about 1,320 crore that has been passed through the income statement, and hence we are seeing the loss on the operational level as well. But if you strip that, I think operationally, I think numbers are good. So I would not see much in that, but we have to see whether now what commentary the company provides, the management provides during the call, because the work is on, and probably they will launch sometime next year if they get at all an approval. So we have to see that. But operationally, this is good numbers.
What did you make of the US sales growth that came out this time around? Is it in line with estimates or it's lower than what you were anticipating?
I think, just give me a minute. So North America about 1,600 crore. What we were estimating about 230 crore. So global generics, we were expecting about 1,790, so slightly weaker than expected. Must be because of the Copaxone that we are not seeing a great traction. Must be because of that. Plus, there were not many big launches during the quarter. So the obvious, there is some decline on the sales number, but then that is again depends on the launches. Novaring was not there. So big product launches. In absence of that, the numbers, I think that's why there is some not beat on the absolute sales numbers.
Okay, Shrikant, we'll leave it at that. Thank you so much for speaking to BloombergQuint. Let's welcome our guests on the show. Joining us today are Vivek, Mavani and Sharmila, Joshi, who are independent investment advisors, along with T.S. Harihar of HRBV Client Solutions. Many thanks to all of you for coming in. On the show today, we discuss the results of ICICI Bank. Recoveries from SRT aided the bottom line, while slippages were elevated in the third quarter. We talk about the results of Ultratech and what do they mean for the cement sector. We talk about AU Small Finance Bank, which has been a ranked outperformer among the peers. The stock is up 80% in the last 1 year. We discuss whether the rally will continue, and lastly we ask our guest about one company whose results surprise them either on the positive side or negative side. But first, ICICI Bank, the results are for everyone to see, in line with estimates, a stable asset quality, so pretty clean number that came out. The stock is up almost 2%. Hari, what did you make of the number? How should, now that most of the private sector banks are out of the number, how would you place ICICI Bank there?
See, I would say optically impressive, because when you say 158% growth in net profits, that is surely an impressive number. But, a couple of, I would believe, words of caution on this particular stock at this point of time, and let me just enumerate a few of them. Number one, I think the profit growth does look a little elevated, largely because of the low base in the corresponding quarter last year. So I don't think we should read too much into the percentage growth. Secondly, if you look at the statements made by the bank itself, there has been a sharp increase in their BB quality portfolio, which is something ICICI has had traditionally a problem with. So I think that is again back. Number three, if you look at the ICICI gross NPA figure, it has definitely come down from about 7.7% to about 6.1%. But even I think at these levels, I would believe that sustaining a valuation of anything above 2022 with a gross NPA of 6.2% is going to be very, very difficult. And today, ICICI is quoting at a very, very steep price to earnings ratio. Last but not the least, if you historically look at the price movement of ICICI, whenever you find a bunch of global brokers coming and upgrading the stock, normally the stock is corrected. And that is exactly what is happening today. Almost every broker, all and sundry, are coming and now hiking the price target of 600, 650. And to me, I think the alarm bells have started ringing. Here is this bank that still has a lot of problem assets. BB portfolio is increasing. Their gross NPAs are still, about 6.2%. The best of recovery recoveries in terms of SR, I think, which was supposed to be the biggest single unit recovery that is already done. So I think with all that, I would believe that further upsides from here should be limited. So we are neutral to probably negative on the stock at these prices.
Neutral, negative. Which was the best private sector bank among the large ones that came out, be it Axis, Kotak, HDFC and IndusInd? Which one was the one that you felt that did well relatively this time?
I would believe that HDFC was okay, but Axis perhaps I would say in terms of expectations, vis-a-vis expectations, I think the performance was the best for Axis.
Okay, that's the view that's coming in. Vivek, what did you make of the numbers and how do you place ICICI among the large 5 private sector banks?
Well, I would say ICICI definitely is moving up the ranks among the large banks after having almost a lost decade with a series of problems on bad loans, which was similar to what some of the PSU banks continue to have. So, if we were to see the latest quarter, in case of ICICI, things are getting better, and it's basically multiple positive factors, according to me, playing out together. So their NIMs expanded because of low cost, because the cost of funds marginally reduced. Hari has spoken about the NPAs. So basically, the gross and the net NPAs both were on decline, although slippages did increase. The yield on advances increased. So basically, even the net interest margins improved. There are non-interest income or the other income driven by treasury gains and fee income was also quite healthy. So multiple positive things played out in case of ICICI simultaneously. Now, excuse me, will that continue? Quite likely on 2 facts. ICICI is now in an upcycle as far as the quality of the balance sheet is concerned, where after SR, I mean, there could be some other recoveries also likely to happen. Their provision coverage is at 85%. So expect some more write-backs in future quarters as well, which is going to aid earnings growth. Third thing, in terms of operating performance, the bank is increasingly focusing now on growth in terms of cross-selling opportunities within their existing customer base where they have liability franchise. So I mean, so people who already hold bank accounts with ICICI to see lending opportunities, whether in retail or in corporate, or even on the corporate side, can they increase their exposure to the same corporates who are reasonably good in terms of credit quality. So that is going to aid growth, which probably will not, which probably is a low-hanging fruit, which ICICI so far has not very effectively tapped, which Kotak and HDFC and Axis have done a reasonably good job over there. And lastly, performance of subsidiaries also in case of ICICI Bank. I mean, the 2 large subsidiaries, of course, the insurance and the securities business, also doing well. Probably there should be some capital return from the subsidiaries as well, although the management in their conference call did not put any number to it. But it is obvious. I mean, the growth in the subsidiaries itself is going to lead to some dividends coming to the parent company. And of course, it's well capitalized, so they are not going to be raising any capital for the next at least 12 to 24 months. They are well on track to reach 15% return on equity, ICICI Bank at the consolidated level, which is reasonably good. Probably, and so sequentially as well as YOY, there's going to be improvement in return on equity as well as return on assets. On a valuation basis, at about 2.5 times consolidated price to book. Not very expensive according to me. I think it's reasonable. One can ride on the improvement and the growth that's going to happen over the next couple of years. So, to come back to your question, among the large banks, ICICI definitely has moved up the ranks to be a preferred play, while Axis has disappointed. So, in a lot of the institutional portfolios, probably ICICI weightage could increase and Axis could decrease. I mean, those things could do, realignments could happen, which will continue to have a buoyant stock price.
Okay, that's the view. And Sharmila, what's your sense on the numbers and its rank among its larger peers?
So yes, I think that has been the story, right? The slippages story has been sort of the consistent story for private banking as a space, and it's been an sort of an unpleasant thing to deal with in this quarter, because so far this lot, I mean, the only reason I'm mentioning it is that because they had held their own.
Yeah.
Most of these names, whether it's an HDFC Bank and they had all held their own in a tough environment. But this quarter we've really seen that pain across that sector, and we've seen the correction coming in price. So, so that has been sort of the consistent factor that you can see getting reflected in ICICI Bank numbers as well. Here, what we've also seen is that just to add to what everybody is saying, because I don't want to go through all that again. The fact that we've seen very good growth on the retail book. I think almost like a 19% growth. But if you were to drill into that 19% growth, then what you find is that there has been slowdown in the typical pockets, like vehicles and houses and so on and so forth. So that also sort of reflects what is happening in the market at large. So the growth has really come more from the credit card and that kind of business, which is not a very great pointer going ahead. So margins have improved, but you don't know. You would wait for that overall market recovery to take it forward. So what I think stands as in favor of the stock at this point in time is the fact that you had the bank sort of emerging from its set of problems over this last year, and we've seen the stock price really rally on the back of that. So the question only remains, can it rally a little more? And I think given that all the stocks have faced similar problems, this probably could sustain a little more. Because it's coming from that the sort of the outperformance that you're seeing is coming from a period of sort of underperformance, you could probably see this carry it forward. So I think within the numbers, clearly I think this would remain my favorite sort of the result in terms of results, and I think even in terms of stock price, you could possibly see it rally a little bit more from here.
Okay, that's the view that's coming in on ICICI Bank. The other number which managed to rally, another stock which managed to rally post the numbers was Ultratech Cement. It rallied almost 3 to 4% post the numbers there. Today it's managed to again move up 1%. While the numbers were in line, I think the commentary and the volume and probably the realization was much better than what the street was anticipating. But Vivek, what does Ultratech, if you analyze the numbers, what does it mean for the stock and what does it mean for the industry, because it's the largest company?
Yeah, of course, it is by far the largest and accounting for more than 20% of the total sectoral capacity at almost 100 million tons. Ultratech almost 100 million tons and industry capacity post all expansions which are in the process. Industry capacity would be about 500 million tons. So 20% share of the sector is obviously very large. I haven't looked at their numbers. I don't track actually Ultratech in too much detail for 2-3 reasons. One is overall sectorally cement demand continues to be muted, although the muted demand is largely because of the lackluster real estate sector. But of course, there is great promise from the huge infrastructure projects planned and announced by the government over the next 4-5 years. So that probably should revive the demand and lead to some sort of a trickle-down effect even on the related sectors, largely about housing and real estate actually. Sectorally, capacity utilization is still sub 75%. I mean, 70-75% would be the range. I mean, depending on which state or region we are talking about. So cement is unlikely to be an upcycle as far as cement prices are concerned. I mean, that cement prices on a sustainable basis rise only when, historically last 20 years we have seen is that only when the capacity utilizations are like 80-85% and there's some sort of shortage of cement leading to higher prices. Last 1 or 2 months, yes, January we have heard about all cement companies increasing prices. I'm not very sure whether that's going to sustain, because we have seen these kind of spurts time and again, but not sustaining. And the capacity utilization is one indicator whether it's going to sustain or not. So I have my doubts on that. On the valuation at about 32 or 33 times earnings for the current year at $200 a ton for a company which still generates only 11 to 12% return on equity. So your largest cement company generates only 11-12% return on equity. I think a lot more is expected from Ultratech. I don't think the stock is cheap by any standard. One can wait for the growth and so on and so forth, but I don't really I'm not really optimistic about the stock price in case of Ultratech, sir.
Okay, Sharmila, what's your sense on the numbers? What did you make of it? And you think that the numbers and commentary probably will be beneficial for the sector as such?
So this has actually been a puzzling thing for me, the way the stock has moved up post numbers, because I honestly wasn't particularly impressed. Because yes, you did see the volume growth, but you didn't really see that because the price was not there supporting it. I mean, when you break the numbers down, you find that because the prices were lower in this last quarter, you haven't really seen that result in better realizations. And it was expected, I think, given the fact that, once you're coming out of the monsoon, you do see better volumes in the last quarter, and that has sort of played out. But you haven't seen, as I said, the prices have been subdued, and that has reflected in the numbers. So therefore, then now you're pegging your story for the entire sector based on the fact that after 7 months, you've seen a price hike in the month of January. And reports are that there have been 2 price hikes in the south, and the south has had the largest price hikes, followed by other regions where there have been one. In many areas, the second price hike has actually been held back because they haven't seen that demand pickup come up after the first price hike. So I think, therefore, that commentary over which everybody is cheering is what I find very difficult to sort of understand and, explain the kind of jump that we've seen in the stock price. Because yes, it was a good number, but I think it's there in the price. And very honestly, you need to see whether this price hike sustains, and you need to see whether the volumes also sustain in this coming quarter. Whether the budget really brings anything very positive for the sector, because this is, in direct correlation with your GDP. So none of the macro data is really supporting any great things for cement as a sector, and you haven't seen it. I mean, as I'm saying, you need to see whether these Jan price hikes sustain. So for me, there is still a question mark. So which is why, as I said, this why has market taken this sort of commentary so positively?
Okay, and Hari, what did you make of the numbers?
See, I think most of the financial details are already covered in elaborate manner by both Vivek and Sharmila, so I won't go into that. The bigger question, I think what Sharmila raised is why is it that the price is going up? And I think there's a very subtle shift that is happening in the cement sector. And I normally take the analogy of the telecom sector, and I'll tell you why I'm taking this analogy. See, what happened in telecom was 4 years back, there was an absolute cutthroat competition, prices started falling, finally it got mergers, consolidation. Today, I think we are left with about, I would say, 3 or rather 2.5 telecom players, because Vodafone you really can't count as a full player at this point of time. So you got about 2.5 telecom players, and the pricing power is back. Now look at the kind of ARPUs. ARPUs of Jio had gone down to 110. It's now to 128. Expected at 168 in the next 1 year. I think a similar kind of situation will gradually happen in cement. So we could have an Ultratech, the second largest Shree Cement, and probably one more player. And I think these all will be national, all India players who will be dominating. So I think gradually we will see that the way smaller players have been either merging out or selling out, we could see a consolidation over the next 1 or 2 years. And I think what the market, in my view, seems to be betting on is that it will become a kind of a winner-take-it-all market. So the whole problem with cement has always been that who has the pricing power? Does the manufacturer have the pricing power or not? And in the last 10 years, they never had the pricing power. And I think once this consolidation happens and we are reduced to about 3 or 4 large cement companies on an all-India basis, I would believe the pricing power should come back. And I think that is what, in my view, they are betting on. They are probably believing that eventually the ACCs, the Ambujas, all of them should either become part of one of these big 3 or 4 players. And then I think the pricing power will come back, and that is what I think. See, infrastructure investments will go on, real estate will bounce back eventually, but it's all about pricing power. So I think that is what the big bet seems to be on.
Okay, that's the view that's coming in on Ultratech Cement. The next one is AU Small Finance Bank did manage to rally significantly post the numbers. It has managed almost to rally more than 20% ever since the numbers came out. Today it's soft in trade, but nevertheless the counter is up 80% in the last 12 months. Sharmila, what do you make of these numbers? You think that valuations are rich now? Will the rally continue?
Yes, so I think a great set of numbers. There's no taking away from the fact that whether you look at it on the NIMS front or the revenue, profitability, everything, I think they really ticked all the boxes there. But yes, I think, going forward, that's exactly my point, that the valuations do seem sort of priced into this. And even if you were to hear the management takeaway post the numbers, it does seem to suggest that they're saying that they will sort of they will sort of deliver the kind of NIMs that they have delivered this quarter, but their concerns are also on their vehicle and home loan sort of business, you know, how much that can grow, commercial vehicle space, how the used car portfolio is changing things around, etc. So they voice their concern in the kind of growth that you can see over there. But yes, I think they have some interesting product like their cash on wheels or cow as they call it for existing customers, etc. So they are definitely going to, their growth is definitely going to chug along. The only question remains is that of valuations, which I think are sort of priced in. So I'm neutral on this stock.
Vivek, what did you make of the numbers? You think that valuations are expensive? Would you recommend anyone to accumulate at these levels, seeing the numbers?
Well, valuations certainly are very expensive at 6 times price to book for the current year, maybe 5 times even on a forward basis. Certainly expensive, and the premium valuations certainly capture or discount to a large extent the superior growth that AU is guiding for growth. Now, there were a couple of things surprising. Now, just context. So, the latest quarter, that the numbers that they declared, the NIMs expanded, obviously because of the portfolio and the lower cost of funds. At 5.4% net interest margin, probably this must be the highest a bank in India earns. I mean, because even HDFC and Kotak or some of the other better banks also don't earn 5%. So that's higher, but that's also because 77% of their portfolio as of December was auto loans and MSME sector, where the yield on advances obviously is high. But obviously that will not, that kind of a mix of the loan book will not remain forever. As it normalizes, as the MSME and the auto portfolio normalize and the corporate loan book increases, the fall in the yield on advances will probably be much faster than the fall in cost of funds. So over a period of time, NIMs do have to normalize on a normalized portfolio or typical of a bank, unless we are going to imagine that this company is always going to have a very large share of auto loan portfolio which will give them very high yields, unless we are arguing that. But that's unlikely to happen. Number one. Number two, even 37% growth in the assets under management. So basically, indirectly, what we are saying is a loan book is going to normalize over a period of time. So if you look at the last 8 quarters, that 37% itself is much lower than, I mean, quarter after quarter that growth number is falling, partly because of the high base, partly because also how fast can you continue to grow and beat the entire sector, which is banks plus NBFCs put together, because AU also competes with other NBFCs in the auto loan business or even in the MSME space. So these 3 factors will also lead to normalization of valuations and normalization of return on equity and return on assets, which so 6 times price to book certainly is expensive if one were to look not immediate 6 months, but maybe over a 2, 3, 4 year period. As far as stock price is concerned, well, talk to market participants, there's a very strong momentum. So it could very well, the rally could very well continue on the strong momentum. But will it sustain for a very long time? I have my doubts.
Okay, and Hari, what's your sense on AU Small?
Again, see, numbers were great. I think profits almost doubled on a YOY basis. So clearly, the numbers have been great. I would agree with Vivek that valuations are about 6 times book are definitely not sustainable, and even the net interest margins, I think at one point of time had touched as high as 7%, of course down to slightly more reasonable levels. But I think that should moderate. My bigger concern on AU Finance Bank is the quality of the portfolio, and let us not forget that they have a very large exposure to Altico, which is now almost bankrupt. Of course, there are arguments that they have an FD against the Altico, but then there are a lot of legal wrangles in this. Altico is probably the only one that we're really aware of, but I'm sure there are a lot more of these kind of exposures, and MSME has typically been a very, very dicey space to lend to. And if there are more cases like Altico, I think the entire advantage that we're talking about in terms of margin should probably vanish in no time. So I would agree that at these levels the comfort is very low, and it is probably, if you're long, it's time to take your profits off the table.
Okay, that's the view that's coming in on AU Small Finance, and we don't have too much time, but we'll still take in the last one. One earnings that surprised you on the positive side or negative side. Hari, I'll start with you. Try to keep it short to close to a minute.
Clearly negative was Kotak Bank.
Okay.
See, here's a bank that struggled to maintain its gross NPS under 1.8% for almost 20 years. And then what we see in the last 1.5 years is that the gross NPS have gone up from 1.8% to 2.7%. So I think that's a very, very huge rise in NPS, which you never expected. And then if you look at the sharp correction in Kotak post the results, I would believe that it is largely to do with the sharp rise in the gross non-performing assets. So we can argue that they still have a 4.69% net interest margin. The growth is still about 25%. But I think the sharp increase in gross NPA to me was the biggest disappointment for Kotak Bank.
Okay, Kotak Bank. Vivek, what's your sense? Which company?
Well, for me, it was Bank of Baroda. I mean, for quite some time, last more than maybe 6 to 9 months, I have been of a believer that as far as the PSU banks are concerned, the worst is behind them in terms of bad loans and provisioning, and probably to 2020 should be the time for recoveries. But Bank of Baroda actually proved us otherwise with the amount of slippages, divergences that they have had to provide for leading to 1,400 crores of loss. So I'm sure nobody on the street was expecting this kind of a loss number. Most people were, including me, were expecting some sort of recoveries leading to at least profit of couple of 100 crores, and this was actually just in the opposite direction to our expectations. So Bank of Baroda certainly was a negative surprise delivered on Friday.
Okay, Bank of Baroda, and what's your sense on the number that surprised or disappointed you?
So surprise and positively, and surprise again positively because it's from a sector that I don't really like, and that's Prestige Estates. A very good set of numbers. If you see, very, very solid in terms of the kind of revenue and profits they've declared for this quarter. But what I like more about the number is the fact that their sales for Q3 are substantially better than what they've done in Q1 and Q2. And the management sounded very confident that Q4 is also going pretty well for them. We have seen some great moves from the stock recently. We've seen that a big name like GIC has invested in them. We've seen the fact also that they could be moving out of that sort of Bangalore and south-based area that they are in, and they are trying to get into Delhi, NCR, etc. And they seem to be having some exciting things up their sleeve. And what I like more, when you hear the management, is that they're not really pegging their future numbers on the fact that there will be any great price increase. In fact, they're of the view that there shouldn't be a price increase, and market should be allowed to consolidate there so that you can give a good offering to your buyer. And that's a strategy, with that whole affordable housing sort of a space with a good product. It seems to be a strategy that has worked well for them, and now it's really reflected in the numbers this quarter. So I was extremely positively surprised by Prestige Estate numbers.
Okay, so those are the counters in which probably was a surprise or a disappointment. So counters like Kotak and Kotak Bank of Baroda on the negative side, and Prestige Estates on the positive side. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests who've come in today, Vivek, Sharmila and Hari. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.